Hey, what's up YouTube? It's Zay here, bringing you Only Hustling Game. And in today's episode, we're going to be talking about how to sell a covered put option strategy on Robinhood. If you don't have Robinhood yet, I'll leave the link in the description below. You can sign up using my referral code, and when you do, you'll get a free stock that you can keep inside the trading platform if you want to, or you can sell it and get yourself some free money, guys. It's free money. Might as well go ahead and get some free stock, right? But with that being said, we'll go ahead and open up our phones and we'll get into this video, okay? And if you guys don't have options enabled, go back to that first video. I actually talked about how you can get options enabled. That way you can do all of these strategies we're gonna be doing, okay? So we're gonna be looking at ticker symbol WISH again. And when you look at the Discover page, it actually talks about what selling a covered put is. It says, gives you the obligation to buy 100 shares of the stock at the strike price. By the expiration date, you'll earn a premium upfront, but might be obligated to buy the shares for an unfavorable price. So where might you want to use an option strategy? Well, for one, if you're thinking that a stock might stay relatively flat or go up, that might be beneficial for you because you'll collect the premium upfront, which is what they pay you for selling this covered put. And if it stays relatively flat or goes up, then you won't actually have to purchase 100 shares at that strike price. So then again too, if you were looking to get 100 shares of the stock anyways, then you're able to get it at a cheaper price. And it's important to remember too that in order to execute this option strategy, you actually have to have the uninvested cash sitting in your Robinhood app already, just in case you actually have to buy the 100 shares. So you actually have to have the amount that it would equal to purchase 100 shares at that stock price sitting inside your account already, which is good because that's why it's called selling a covered put. It's covered already by, the securities that are uninvested. So let's go ahead and just pick a date real quick. We'll go to September 17th, and again, this is ticker symbol WISH. Okay, so this is after hours. The market's closed. The current trading price of WISH is $7.17. If we look at, for instance, the $6 put, and if you see right there, it's in the red, it's negative 26%. It's on sale basically. It says we have an 81.35% chance of profit, and our break-even price is going to be $5.86. All right, so max profit, $14. It doesn't sound like a whole lot, but when you're doing these option strategies kind of frequently throughout the week, throughout the month, that slowly starts to build up. And especially if you have that cash that's sitting in your account that's not doing anything, this is a great way to collect premiums and add value to your portfolio, especially if it works out the way we want it to. So let's look at the P&L chart. So our break-even price is $5.86. If for some reason this starts falling down, guys, it'll show us our max loss being $586 in total. Our max profit is $14. So it'll just show it if it goes up. Again, we kind of want it to stay relatively flat or go up because in that case, we just collect the premium, nothing else happens. We don't have to purchase 100 shares. So that uninvested cash that you have in your account will just stay there. You won't have to execute it and purchase 100 shares of the stock. If you weren't looking to get 100 shares and it does trade below the strike price before expiration or when expiration happens, then that's not good because all that uninvested cash, you're purchasing the stock. So just be careful and just really know what you're trying to do when you sell a covered put. Make sure you really research that stock and have a strong conviction thinking that it's going to stay flat or go up. And in this case, guys, I told you guys that when it came to buying a call option, personally, I like to pick a date where it's farther out. That way it gives chance for more volatility to happen so the stock can shoot up. But in this case, guys, personally, I like to choose dates that are a little closer out, just because if for some reason I pick a date that's farther out, there is more chance for volatility, which can be decent in some cases, can be okay, but I just feel much more comfortable doing it a little closer out, especially when I research that stock pretty thoroughly and I think that it's going to stay flat or go up. You never know what's going to happen. There can be something that comes out in the news to where shareholders decide just to sell off and the stock tanks. If news came out farther out and that happens, then I'm now getting prepared to purchase 100 shares at a certain strike price, right? Which for me personally, I don't really ever want to purchase just 100 shares just outright all at one time. I like to slowly build up to that. There are certain stocks that I do want to own 100 shares of, and on that one, once you get 100 shares, we can actually start running the wheel strategy on that, and I'll start talking about that in future videos. But for this $6 put, guys, it's not bad. Like I said, I show our max losses, our max profit, and if we go over here to Investopedia, it just gives us our key takeaways, things to really remember when selling a covered put. For one thing, it generates immediate portfolio income to the seller because you have that uninvested cash in your Robinhood app. You're not doing anything with that money, so why not collect some premiums on it, right? An investor who sells put options and securities that they want to own anyways will increase their chances of being profitable, because why not, right? If you actually purchase 100 shares at a very, very reasonable price, way below than what it was trading at originally, and then it does start going up a lot, it has a 52-week high, or it has, you know, an all-time high again, then you're making a huge profit on, you know, those 100 shares. So selling a put option allows an investor to potentially own the underlying security at a future date and a much more favorable price. We already know that. So yeah, guys, that's how you sell a covered call. Again, it's called covered for a reason, because you already have the money that is needed to purchase 100 shares inside your portfolio. Do these too often, being honest, I don't. I like to buy call options a lot more than I do selling a covered put, but this is just another strategy that you can add in your arsenal when it comes to option strategies and investing in stocks. Another way you can collect some money on uninvested cash. So I hope you guys liked the video. Please remember to like and subscribe, because when you do, guys, especially if you're interested in just finance videos in general, the way YouTube's algorithm will work is if you start liking and subscribing to certain channels that talk about finances, it'll actually push out other videos and into your recommended feed. With that being said, guys, I hope I see you in the next one. Peace.